collateral is critically important to the monetary order. And the most pristine, perfect form of collateral that you can use to then borrow more money is the US Treasury Bill. But there seems to be a shortage right now. Why? We're going to talk about it. We're also going to talk about whether or not it means trouble yet. Not yet. How will we recognize when it might mean trouble? What sort of dials, switches on our monetary dashboard need to go into the red before we think there's something going wrong? We're going to talk about it next with Jeff Snider, the head of global research of Alhambra Partners. Jeff, the article for those that want to read along or sing along, maybe. Have we thought about doing that, Jeff? A sing along with the little ball and the dot and the words? Maybe.
Well, I hope that doesn't fall to me since you're going to do the dancing, because I don't have much of a singing voice, and I'm not sure about you as a dancer either. So we might just have to close the whole program down at that point.
How dare you? No, but you're right, though. I had to leave Hollywood. I couldn't make ends meet dancing at private residences. Yeah. All right, we discussed that in part 1. Okay, some next steps to watch for scarce collateral. That's the title of a blog post at Alhambra Investments by Jeff Snider, September 24th, 2021. Here it is. First of all, we're going to talk about what's happening with Treasury bills. Are there enough of them? Then we're going to talk about what are some of these measures, balance sheet line items that we can look at to get a sense of what's happening out there in the shadows. First thing we want to talk about is Treasury Secretary Yellen losing breathing room with what? The debt ceiling, the amount of bonds, bills available?
Amount of ability to borrow more from the rest of the world, really from the banking system and hedge funds and things like that. So Janet Yellen has been, ever since the summer and even before then, cutting back on Treasury bill issuance because she doesn't really have any choice. And as I always say, the Treasury Department, whether it's Yellen or any other Treasury secretary, they don't focus in on collateral. They don't care about collateral. Their primary task and their sole task is really just to manage the federal government's deficit. And so it's immaterial to the bill issuance in particular, that the fact that Treasury bills have become and have always been and become even more so a huge part of the repo derivatives market, collateralized, secured funding transactions, whatever you want to call them. They are key and play a key role in all of that. So Yellen's doing what she's got to do to manage the deficit situation according to congressional mandates and laws and statutes. And the money markets are saying, we want bills, we want more bills, we need these bills because they are our primary source of collateral.
But yet, this graph that I've pulled up shows in these pink columns down at the bottom that there is less of them coming out. And on top, what we see are the high, low, median auction values. So we're looking at the primary market, right? The first offer to primary dealers and what the yields are and what they're bidding. And what we see is as this issuance is scaling down, we had seen a rise in yields, but recently we've seen them turn down. And right now we're looking at the US Treasury 4-week bill equivalent, but guess what? We see the same pattern in the 8-week bill equivalent yields. So Jeff, what does that mean?
For the 4-week and why the 8-week went before the 4-week is that money market funds, out of an overabundance and overabundance of caution, decided they didn't want to hold any bills that might expire during or when it was anticipated this debt ceiling drama would be at its maximum, just in case there was an infinitesimally small chance the Treasury Department doesn't pay off a bill issuance, because for a money market fund, obviously that would be catastrophic. It would have to break the buck and all hell would break loose from that point forward. So some money market funds like to avoid any specific QSIPs that fall near or even just a little bit after when they anticipate the debt ceiling to be at its most serious drama. And that had caused first the 8-week, because in August October fell into that 2-month window. And then in September, the 4-week, because then again, October falls into that window. You see money market funds start to avoid those two particular issues. But then late in September, I'm sure the money market aversion continued, but for reasons of likely scarcity, the rest of the system piled back into those bills regardless. Now, maybe that was just the market saying, we don't believe the debt ceiling is going to be any problem whatsoever. We changed our mind and we're not even going to be averse at all. Or it really is that there are so few bills that the need for bills is overwhelming whatever distaste money market funds have for them. And I would imagine it's more the latter than the former.
We can observe that just in the prices paid for these bills, but we can also observe it relative to the Fed's reverse repo program. I'm going to pull up a graph and you're going to explain to us what the most recent activity signifies when all of a sudden we're below that reverse repo program, if I remember correctly, is 5 basis points.
5 basis points since the middle of June. And you're right, Emil, because the Fed's reverse repo is an alternative to all of these things, right? If you're a money market fund or a dealer or whatever, and you have cash, excess cash, then you can buy a treasury bill, of course, if they're available. If they're not available, you can lend your money in the repo market because it's secured and it's just as safe. But if not enough collateral floating around in repo, you can't find a sufficient number of collateralized borrowers, you can go to the Federal Reserve's reverse repo window, which now the counterparty limits have been doubled to 180 billion a day, which means you can pour a lot at the Fed, which gives you 5 basis points in return for lending the Fed's bank reserves back to them. That's how ridiculous this stuff is. However, as we see in some of these treasury bill auctions, dealers and investment funds, because remember, indirect investors in bill auctions are not foreigners, they're actually investment funds. So you see indirect investors and dealers overbidding for treasury bill collateral beyond the 5 or below the 5 basis points the Fed pays at reverse repo, which tells you they are valuing bills well above where they quote unquote should. Because if your alternatives are less than 5 basis points in treasury bill or 5 basis points at the Fed's reverse repo, if your only consideration is investment return, no one's going to buy a bill for less than 5 basis points. Yet it happens time and time again, and more consistently when there's fewer bills out there, because treasury bills in particular have collateral value over and above their investment return characteristics, as we can clearly see with the relationship to the reverse repo rate.
Now, you explain in your article here that none of this is sign of imminent danger. It's interesting behavior, but not signaling imminent danger. What might signal imminent danger? We're going to go over some of those that you provided us here. Let's see. Number one is outrageous price behavior in the secondary as well as primary markets. So we were just looking at the primary markets, and in the secondary markets, we would see yields plunging lower. Is that right, Jeff?
Especially our scramble for collateral early morning slams. If we saw those where, you get the 3-month treasury bill trading at 0 in the early hours of the day, or during Asian trading in particular, that would be a key indication. Hey, what we're seeing now is a collateral scarcity that's becoming more of an outright shortage, and that's where it becomes really a bigger problem, or a bigger potential problem.
Option number 2, measure number 2, dial number 2. Some treasury bill issues are available for rent, you say, via the central bank's securities lending program. And then you say that this is not a preferable option for various reasons. You won't go into it here. Why? Tell us a little bit about this measure.
Yeah, I think it maybe blows a lot of people's minds that the Fed is in the securities lending business too. They understand how the system works. They just don't understand the implications of all these things. They certainly don't place enough importance on collateral. But yes, the Fed has several trillion of, what is it now, 4 or 5 trillion in assets in its portfolio. The treasuries that are in there, several trillion of those. Many of those are available for the market primary dealers to knock on the Federal Reserve branch of New York, knock on their door and say, I want to borrow the security from you overnight. I'll pay you X number of dollars. It's actually an auction process, which is one reason why this is not a preferable option. But either way, you can see that on a daily basis, the Fed does lend out about 30 or 40 billion dollars in treasuries into the marketplace. And those have to be repaid with a little bit of interest the next day. Some of them are term, but most of them are overnight. And when you look at the Federal Reserve's current securities lending program outstanding, nobody's borrowing treasury bills. Very few treasury bills are being borrowed, which actually makes a lot of sense. I mean, that's one of the reasons why you have a treasury bill in the first place, is that you don't need to borrow it.
And so if something was going wrong, we would see more borrowing, whether it's the overnight or the term. And then, Jeff, is the term
if you saw
multiple days?
Yes, if we saw lending at the Federal Reserve securities window go way up, that wouldn't be just a sign of trouble. That would probably be a sign of imminent or serious trouble, because as I said, this is sort of a last resort. And it's true.
Good.
We did see something like, for example, in 2020, there was a noticeable uptick, even though it wasn't a whole lot. I think it got up to 45, maybe 50 billion in some days in March of 2020, where collateral was in such short supply. As much as it's distasteful to go to the Fed securities lending window, that actually did happen. So it's an indication of more serious stress if we see an uptick in securities lending activity at FRBNY.
Okay, measures number 3 and 4 are related. Number 3, scaling back the Fed's QE reinvestments, both absolutely, which is number 3, but then later on here you point out number 4, proportionately changing them as well, perhaps. Tell us what you mean by both number 3 and 4, scaling back and then changing the proportion of an investment here.
Yeah, we spent an entire episode on this previously, which was, going back to 2019, the repo stuff, the not QE, while the Fed had bought a lot of Treasury bills. In fact, they were buying exclusively Treasury bills under not QE 5, and how that was a huge mistake. And it was the worst thing that they could do. And then the Fed actually admitted that it was a mistake because they stopped doing it. And when did they stop doing it? Right in the middle of the March 2020 crisis, when things were so bad. So they realized that this was a big mistake. They were stripping the marketplace of these Treasury bills that it badly needed. Remember, all Treasury bills are on the run, so they're taking the best of the best of the best quality collateral out. So ever since that particular, I think it was March 26th of 2020, the Fed's SOMA holding of Treasury bills has been exactly the same for 80 weeks running. And I'm including this week in it, which this was written last week, so it was 79 last week. So for 80 weeks in a row, all the Fed has done is reinvest expiring bills to reach the same amount. It's exactly the same week after week after week. They don't buy any more, they only reinvest. So if we're thinking that maybe like March 2020, where the collateral system goes from scarcity to shortage, the Fed could theoretically, assuming it was first of all wise to what's going on, and second of all proactive about it, or even reactive about it as it was in March 2020, they could, instead of reinvesting those expiring Treasury bills, just let them roll off the SOMA holdings, allowing more at auction to be available to the marketplace. Or they could, in theory, though I don't think it's likely, but if things really get that bad, maybe they could actually outright sell some of their bills into the marketplace, which would mean, even as QE is going on, even as they're adding more bank reserves for buying more Treasury bonds and notes, they could sell bills, sort of an inverse twist here, sell bills, or actually it would be twist, sell bills and buy more bonds, even more bonds and notes, therefore maintaining the pace of QE while changing the mix of purchases within it, the proportion of what's being bought, and actually being negative on Treasury bills. So if the Fed starts to alter its SOMA holdings beyond, for not an 81st week in a row at 326,044 million, then maybe that's an indication that the Fed sees something. And if the Fed sees something, that's an indication even more that something serious must be amiss in the collateral thing. And just to be clear, these things are not happening. There's no indication that these are going on right now. These are just some of the things that we would, if we saw them take place in the Fed's holdings, then that would tell us that something has changed. There is a materially increase in collateral pressures and potential risk.
Exactly. We've gone over 4 measures so far. As you just made very clear, they're not at elevated warning yellow, amber, orange, red levels. But here's one that is, and that's measure number 5. And we've briefly mentioned it already. And we talked about it in a big long episode already, but the reverse repo program at the Fed, it is very elevated, Jeff. Any thoughts, any update of where we are right now at the heights where we're at right now? I've stopped counting. Where are we? $1.3 trillion now?
Yeah, it's getting up there, right? And that's really the only reason people have paid attention to it, because, hardly anybody knows what it really does and what it's for. Yet it's such a big number, you can't really ignore that, 1.3 trillion, nor can you ignore the speed at which that was reached, right? I mean, no, it just kind of showed up out of nowhere in late February with FedWire. There's a little tickle there. And then mid-March at the top in bond yields, all of a sudden, those two things were correlated almost exactly. We had deflationary pressure and we had the revise and the reverse repo, which suggested those two might have been related. But it's never been easy to disentangle all the potential causes for reverse repo's upward slope, which is, as we just said, the simple dearth of treasury bills would cause some money market funds. They can't buy a treasury bill at a reasonable price, so they just park money at the reverse repo. And how much of that is money market funds being unable to source collateralized borrowers or find collateralized borrowers in the repo market because there isn't enough collateral. And that's why they're going to the reverse repo. So regardless, the reverse repo tells us that there is a dearth of options for most of those funds that are putting money with the Fed, which then proposes that there is some level of scarcity in these instruments, which provide not just the best of the best of the best form of collateral, that in many ways they're the backbone of the frontline defense in the collateral system, which is so fungible and so dynamic that this is a really important thing. It's a really important factor to keep in mind.
I'm going to add two more line items that we're going to discuss. The first one is that people can go to and see, where if they're elevated or depressed and what that might mean.
Yeah, all this stuff is publicly available information. And I know you would do the same thing, Emil. We always try to use publicly available information because we want people to be able to do this for themselves. We're not going to throw black box models at you or our own private calculation. Everything is publicly available. And really, the only service we're trying to provide is, how do you interpret the data that you can get your hands on?
Let's interpret this line item. Securities in custody for foreign and international accounts, US Treasuries. I'm going to pull up the graph. This one, if we see this line falling, I've got the graph pulled up now, that is trouble. It's warning because, foreign official central banks, they let the Federal Reserve hold in custody US Treasury securities because of all the balance of payment issues for running a business, because fine, keep it in New York. It's like a custodian, like a correspondent bank, right? For these treasury securities.
And that's exactly where this accommodation grew out of. It was a foreign custodial correspondent system, sort of, hey, you're going to need dollars in New York anyway, so let us hold your assets here. And then that became, let us hold your treasuries.
But like everyone who has a savings account off there for some reason, when things get bad, you're going to draw down that savings account. Same thing with treasuries. If all of a sudden what we've seen over time is this line item decreases when there's trouble in the monetary system, the foreign official accounts need to take those treasuries out of custody and use them to, I imagine, to subsidize their own internal banking systems. And we've been on a downtrend. So that's negative. That's bad news. The most recent updated data, an uptick. So I guess that's better.
In September, which is consistent with the rise in yields and the seasonality and optimism and things like that. So you're right, Emil, this corresponds not directly, but in seriously enough correlation with the tick data too, which shows that we tend to see net selling in tick or net outflows from custody and Federal Reserve custody. Those two things tell us dollar shortage, collateral problems, those kind of things, deflationary pressures as well.
My last contribution to the show, foreign official plus international accounts, reverse repo program. So it's a subset of what we had been talking about earlier. And let me show you this graph. When it rises, it corresponds with trouble. A surge in this line item means something's going bad. I'm showing data going all the way back to 2004. If we zoom in, we see that this line item is increasing. Most recently, we've had a little bit of a downturn heading the other direction.
Right? Since March, there's that convergence point. Same as the reverse repo. And, a lot of quote unquote mainstream gurus like to say that there's something going on with the reverse repo rate because we don't know what the Fed pays the reverse repo accommodation here. But whatever, regardless, as we see in TIC, as we just showed in Federal Reserve custody of foreign UST holdings, there is a corresponding correlated pattern between how these things move together that matches up with bond yields and inflation expectations and real yield and Eurodollar futures and all the stuff that we talk about. It produces a comprehensive picture of what must be going on in the shadow money system. And ever since March, that's not good things. It's more bad than good, more deflationary pressures than inflationary pressures. And if we try to break those down into further pieces, looking at, as we started out with this episode, collateral, it's, there's scarcity in collateral, which is probably contributing a lot to this tightness. It hasn't gotten so bad that it's creating real serious imminent danger.
Today's episode was brought to you by Macropiece Theater, where I play the role of Alistair Cooke and introduce various interesting essays by geopolitical strategists, macroeconomists, and I simply read them aloud. And that's it, because people are busy, they're doing things they can't be reading themselves. It's pretty successful. People have said, hey, this is great, this is very helpful. I'm in a commute, I'm nursing, I'm exercising, I'm running from the police. People are very busy. They don't have time to sit down and read. And so over this last week, I have read pieces by Jeff. Jeff's presentation to the George Gammon Rebel Capitalist Live conference in June. I've also read pieces by Lyn Alden and Daniel Oliver, Karl Marx, George Friedman, Michael Pettis, the BIS. So it's pretty good, pretty well received so far. You can find it on this podcast feed, wherever this show is. Whenever Jeff's not on live, I'm reading things on a daily basis that you may find interesting. These things are about like 10, 15, 20 minutes. Jeff's presentation at the George Gammon Festivus Spectacular was an hour, but it was one of your best, Jeff. I really enjoyed it.
Thank you. I appreciate it. I'm glad that you're doing it because, as we often say here, you don't want to throw the baby out with the bathwater. And I think the fact that some of your selections already show, sometimes you need to hear about Karl Marx and some of the things he said. Sometimes you need to read John Maynard Keynes, despite what neo-Keynesians do in his name, and some other thinkers. I think you said Daniel Oliver's one. Mm-hmm. Maybe we would have a spirited debate and have very, very different views on the world and central banking, but he's obviously a very smart guy, and maybe something he says sparks interest, and it's really good to have a rounded view, a rounded knowledge base of what other people are thinking too.
The longest serving radio talk show host in America often says that he prefers clarity to agreement, clarity of differences, so that the audience can then decide for themselves. And so by bringing these various voices, by reading around as opposed to narrowly, people can decide. They say, well, this person's very smart and these are the points. Let me consider them. So I appreciate it, Jeff. I had a great time again. Hopefully next week we can do it again.
Absolutely. It's autumn. Autumn is the time to be happy. Autumn is the time to be eternally optimistic, even if it's just a few basis points in treasury yields.
All right. Thank you, Jeff.
All right. Take care, Emil.